Welcome to IVoT Presents Wall Street Week in Review with your host, Emil Westergaard.
There's something happening.
Good morning and welcome to IVoT's Wall Street Week in Review. Today is Saturday, July 28th, I believe. Is that right? 28th or 29th? 30th, sorry, God, I was thinking about July 30th, Saturday, July 30th. We're going to, as usual, be reviewing the market action for the week and then be looking at three companies today, Apple, Google, and Tesla. Obviously not as long a look on each company as we would do if it was the whole show, but the reason we're looking at them is because they all reported in the last week or so. So we have new forecasters. So what we will do then is look at each company's latest forecaster for their latest quarter, which is the quarter ended June, and compare that to the prior quarter and see what happened to cash flow, see what happened to business, and see how it affects our overall view of the company. We'll then finish off by taking a look at the company in regards to the IVoT hedge fund and decide whether or not we want to continue to own the company if we have it in the hedge fund, add to the position, or potentially get out of the position, even possibly short the position. We do intend to begin shorting companies in the IVoT hedge fund. We haven't done any shorts yet, but there's going to be a first one. I will just say again, and we'll discuss that when we get to the hedge fund. Why do I not get stuck on that topic? So before we do all of that, let me just take us quickly. I'll share screen to IVoT Academy just to remind everyone of any kind of interesting activity on the Academy this week. So we have as here the new tool for Tesla from Armando. We have the new tool for, and Armando will be talking about Tesla today, by the way. We have the new tool on Microsoft, or actually this is the first time that's been posted, I believe, for Microsoft, right? Is that true, Ruslan?
Yeah.
Yeah, so this is our new tool for Microsoft, and maybe in the next couple of shows, we'll do a show on Microsoft, and Ruslan can take us through it. We have the video from last week's show, had a good show. We have the new tool on Google, which Ruslan will discuss today. And I will be discussing Apple today, and I will be publishing the new tool after the show. We have Meta earnings is coming up. Oh, Meta reported this week. So we will be getting a new tool on Meta from the analyst Hamza, I'm sure, next week. So keep an eye out for that. Walmart cut their full year profit forecast. So something's up at Walmart that they are missing their guidance. Again, let's just remind ourselves that companies give guidance for the future, usually for 1 quarter and 1 year ahead. And let me ask Ruslan, when they give that guidance, do they want to be aggressive, neutral, meaning do they want to try to give guidance that's better than they expect, be kind of hyping? Do they want to give neutral guidance, meaning here's what we really expect, or do they want to be conservative?
Conservative.
Right, they want to be, and why do they want to be conservative?
Because if they get aggressive with their forecasts, there's a risk of over-promising and then under-delivering, and the stock could actually do negatively when the news comes out in the future.
Right, so if they miss the numbers, that's a negative. So the guidance has been conservative, and when Walmart, who, as we're saying, has been giving conservative guidance, has to cut its forecast on conservative guidance, that means they're doing worse than their conservative guidance. So it's a kind of double negative, right? So maybe David wants to build a tool on Walmart for us. We'll see if we can get him, because we need someone to build a Walmart tool. That's a real central company to the U.S. economy and a bellwether stock, you'd call it. We have the Meta tool, and I think that's it for me for this week for new stuff. So let's now go to the market. Russell 3000 for the last 5 days was up 4%. That's a very strong up week for the market this week. That is essentially, again, if we think about that on an annualized basis, that's very strong positive volatility, you could call it, meaning the market appears to feel much more comfortable than it did a week ago. We are, if we look year to date, we're now only down 15%, so we're well below bear market territory now again. And so let's just look at one other number that we look at, and then let's discuss this for a couple of minutes and see if people have thoughts on this. Armando, why don't you just report? Why don't you explain this to us for a minute? So tell us what the Russell implied vol is right now.
So the implied vol is 18.6. That's very low. That means people
wait, careful. Don't add words that you shouldn't put in there. Is it very low? What's the percentile rank?
49%.
Right, so it's right in the middle, right? Basically anything. So it's exactly essentially the median of the last year. This is the midpoint of the last year. So 50% of the time it's been higher than 18.6, and 50% of the time it's been lower. This is right in the middle, right? So stay with me, Armando. Let's talk this through. So Armando, if it's above 50%, what do we say? What do we say about the market psychology when vol is above 50%, above the 50 percentile rank? What do we say?
People are feared to invest into this.
Yeah, it's a fear-based market, right? And when it's below 50%, it's a hope-based market. People are looking at the future with fear, or they're looking at the future with hope. And we can see that as recently as mid-June, I can tell you this was the 100% vol. So in the last month and a half, we've gone from 100% vol, or total fear, down to neutral. We're now basically right at the median. We are in middle ground. Generally speaking, Warren Buffett, our guru, would tell us we want to be investors when? Do we like investing when people are hopeful or fearful?
Fearful.
Fearful, right? Because that's when you get in the bargains. When hope is starting to come back, you got to be more careful because people are getting optimistic about the future. Right now, we're sitting in a very neutral land. And so we can take a look at whether what that means for the underlying assets. But let's just now let me open up the floor here for a minute to Gala, since she hasn't spoken yet. Oh, you don't put your mic on, right? Okay. So Gala's gonna be a passive listener today because she was not turning on her mic. Maybe she'll come over later and join. David, what do you think about the fact that the market has had this rebound in sentiment in the last, since the middle of June?
I think people are getting more comfortable with the environment and are starting to put a little bit more into the market because of that fact.
Okay, I think that's the mechanics of it. You're right. So we know fear is going down. People are getting more comfortable investing. So fear has become less, and that is the mechanism, right? We know that in part because because people are putting money in the market, so that the market has been going up for the last month.
But we're asking like my pain though.
Well, I'm asking that's not a bad answer. It's kind of reiterating the statement. But now, why do you think that is the case? Why is fear among investors coming down so quickly? I mean, again, it was at 100% a month ago, and now it's at 50%. It's declined by 50% volatility relative to the median in the last month. So there's been a huge change of sentiment in the last month.
I think it has something to do with what are the Fed or the White House were releasing in news.
So I think you're definitely in the right land. I mean, I think that the first thing we could say is what's been driving fear so far this year has been primarily inflation, with call it a bit of war thrown in there, because Russia definitely has added to global uncertainty. I know the Europeans are struggling with gas supplies and all kinds of things. So those are the two driving factors. So we can start out by saying there's not been any material. Let me put it this way: my media feed has been much lighter on Russia, Ukraine. And again, a lot of what people think is driven by what they see in the media. So the media feed on Ukraine as an issue in the US anyway has been lighter. Though I do think that the issues around the oil and gas supply in Europe are still very problematic as far as I can tell around the war. And that is a potential source of inflation, though as far as I can tell, the longer that goes on, countries start to work out new supply chains for oil and gas. So there are, it's not like Russia owns the global market, and Russia also needs to sell this stuff. So it's not, one of the beautiful things about the economy in the context of war is, Russia needs to have an economy. So as much as they may want to be, a military force, they have to be aware of the fact that they have to continue to be able to have enough of an economy to feed their people. Otherwise, Putin's going to get in real trouble. Any other thoughts on Russia before we go on to the inflation issue, which is really, I think, the bigger one? Okay, well, then the second one, I think, David, as you're pointing out, is inflation and the Fed, right? So the Fed, we've had this very high inflation. The target rate for the Fed is 3%, and the last report was up at 9.6, I think, which is literally 3 times the target inflation rate. That means that everything that people are buying is getting more expensive, which has two effects. People demand more money. So you have people go on strike, and then that adds to inflation, which makes inflation a very dangerous kind of circular reference. People need more money if everything's priced higher, and then they demand more money, and then that causes the prices of things to have to go up to cover the higher cost of labor, et cetera. That's one issue there. Obviously, the other thing is when inflation goes up, prices go up, people buy less, right? So there is a built-in a sense, potential break to inflation at some point because the economy starts to slow because pricing is going up. However, in order for the Fed to try to handle inflation, they raise interest rates, correct, David?
Yeah, correct.
And the Fed has been raising interest rates this year. Maybe Ruslan, can you Google the Fed rate raises this year so we can just see how many raises there have been this year and where we're sitting right now?
Yeah.
So, David, to your point, if inflation has been the primary driver of fear, then we would have to say in a simple way that people have become less afraid about inflation, right?
Right.
Now, this move down, which preceded the move up, there was a move down right here, in here, which was the last inflation numbers were actually higher than expected, higher than the Fed had led us to believe, right?
Mhm.
But when those numbers came out, and I'm not sure which one, it was probably this one, the market went down for a bit, but then it quickly rebounded because, to your point, Biden and the government came out and said, well, those inflation numbers were overstated because gas pricing has come down. And that would be another interesting thing. Armando, you want to look up the gas prices? You should be able to get a chart of the price of gas this year.
Sure.
And let's just look at that, because these are kind of bellwether numbers, right? We need the Fed rate and the price of gas are two things that.
You want gas for New York or in general?
I think you could probably get it some kind of chart of gas prices. Just Google gas price chart. Yeah.
I got it.
Okay, Gala was asking me what I mean by people are less afraid of inflation. Well, what we're saying is that inflation has been the driver of fear in the market. And we can see that through volatility. A month ago, volatility was 100%, was the highest it had been in the year. And in the last month, volatility has dropped by half. It's now only at 50%, it's at the median. So fear is what the driver, if inflation has been driving fear, then it's been a reduction in inflation. There must have been a lessening of fear about inflation. Well, it's by volatility coming down. The market is essentially our diagnostic tool. The market's telling us that fear is coming down because people are becoming more comfortable investing. They're more willing to invest their money. And that, I'm gonna try to look at the screen, not at you. But we can look at each other on the screen while we're talking. Yeah. Gala's in the room with me. All right. So, and I don't know if people can hear what she's saying, but basically she's just asking me about this concept of fear. And again, the concept here is that if we want to look at the market psychology, the volatility is a perfect way to look at market psychology. That's really what it is.
Very, very good question.
Okay. So do we have any answers there? Ruslan, what's happened to the Fed funds rate? Where is it sitting right now?
Yeah, I could right now it's sitting at a target range of 225 basis points and 250.
Okay. Well, that's the Fed rate is not a target. There should be a set Fed rate at the moment.
Yeah.
So
Well, yeah, I guess so 2.25% to 2.5% right now.
okay. So that's, and I think it began the year closer to 1%. So it's
No,
double.
it began at like 0.
Oh, began the year at 0. Okay. So
I
0.
can share my screen. Yeah.
Okay. You want to share? Go ahead.
Yeah.
Grab that for me. Hold on. Go ahead.
Okay, so this was the table I was looking at.
Oh, look at that. Great. Okay. Got it. Got it. Got it. And so the next meeting is in September 21st. So actually, this is a really good sheet, Ruslan. We should publish this on the site and also put this in the calendar. Okay. In the events calendar. Cool. Now we watched a video, this is now about a month and a half ago, by Jim Grant, who's publishes the Interest Rate Observer, who's a kind of leading commentator on the Fed, who said that according to the science of economics and a kind of law of Fed funds relative to inflation, by some, and we should watch it again. There was a professor at Stanford who probably won a Nobel Prize for this, but basically, according to that, the calculated Fed funds rate earlier in the year needed to be closer to 9% to get inflation under control. So he was back early in the year when, and I think inflation then was around 6% or 6 to 7. He was saying that the Fed funds rate needed to get up to 9% to get inflation under control. Well, the Fed's been acting. They've been raising rates slowly, putting the brakes on, because raising rates makes it more expensive for everyone to borrow money, right? Basically, this is they're basically raising the risk-free rate. They're raising the cost to borrow money, and you can also loan money to the government and get a better rate. So it kind of gets the government to take money out of the system. So I guess the question obviously is how high does the Fed have to raise the rates to get inflation under control? We know that the last inflation reading, and in fact, that's another thing would be to kind of get the month-by-month inflation numbers. Maybe David, can you try to pick that up while we're talking here for a minute? What was inflation each month this year? Just Google it. But basically, I know inflation's been going up every month. It went up again, even more than the Fed expected in July. We're going to get the August numbers coming up, in the next month or the next couple of weeks. And then the question is, the Fed and the government was saying they think that's going to now start going down because of gas prices going down already. So if that's the case, and if we see a reversal in inflation, then the government will have been right, and we can see that the market's already believing it, right? The market bit. The market said, okay, if the government's saying inflation's now going to be going south, because the government has the data, right? They publish it, but they see it in real time. It's almost like a stock, in the sense that we get company information every 3 months. We get government data every month. By the way, Ruslan, could we build a massive forecaster for the American government? We could.
Yeah.
We will. We will. They have revenues, they have expenses, and they have either excess or they claim that they have a deficit, but we have to look at that. We could actually evaluate where's the deficit coming from and, what's the health of the system, right? Okay. And ultimately, when we talk about the Fed funds rate, we're talking about their balance sheet, right? Because we're talking about the interest rates on their balance sheet, and they control the interest rates on their balance sheet, right? By the way, one of the problems they have with raising rates, if we think about it, again, I'm not an expert on this stuff. I'm a stock market guy, but we can talk about it. We can all challenge me on this, please. But if the U.S. government right now, Armando, Google for me, what is U.S. government debt right now? What's the total U.S. government debt?
$28.43 trillion.
So basically $28 trillion, right?
Mhm.
And if they owe that money to whomever they borrowed it from, they have to pay interest on that debt, correct?
Correct.
And if they're paying interest on $28 billion of debt and they're raising interest rates on themselves, right?
Mhm.
Interesting, right? A bit of a problem for them. Why do you think they wanted to have interest rates at zero? Part of the reason was they didn't want to have to pay any interest on their debt. Because what have we done since 2008? Oh my God, there's so many interesting topics here. This is really, I mean, it's good. We should really collect all this, and put it on the IVoT site as kind of the beginning of a data sheet with discussion. But let's think about this for a minute. If we collected year by year what the government debt has been since 2008, because what happened when the market collapsed in 2008, when the housing market collapsed, in order to rehabilitate the market, the country just, they printed tons of money, issued tremendous amounts of debt to try to stimulate the economy, to push money into the system. And so, you think about, I think the annual economy in the US, if I can think about it, I don't know. This is a wormhole. Let's stop here. We've covered a lot of territory. There's a lot to discuss here. We're not going to finish it today, but I think it's a very interesting topic. Why don't you stop your share, Ruslan? Let's just wrap it here and go on to the stocks. But I think we can summarize by saying that the market fear has come down a lot because fear of inflation has come down a lot. I think that is somewhat hinged on government guidance that gas pricing is a precursor to inflation coming down. And so while Jim Grant's math tells us that the government isn't nearly high enough yet in terms of the interest rate to control inflation, the government's saying they expect us already to see a reversal in the inflation rate. So I think we're at neutral in terms of the fear factor, which would argue, I guess, in my mind, that there's a certain, let's see. And I think the C is going to be what's going to happen with the August inflation number, right? If August inflation is down from July, then I think you might even get more market rally. We might move into hope territory. Because I think there are two ways. Obviously, inflation, if it continues to go up, has all kinds of problems in itself, right? And then the other thing is when the Fed is raising interest rates, they're putting the brakes on the economy, which will lead us into recession, which means we'll be losing jobs and there'll be less money in the system. And so that's not going to be good for the stock market, right? Profits going to go down. So right now it looks like people are looking what's going to happen. So let's just say this, that I don't think any of us have enough knowledge to prognosticate what the next inflation number is going to look like. I never consider myself having more knowledge in the market. There are certain people who I think are very good to listen to, but in general, I think there are people who are macroeconomic investors who invest on these big global topics. They invest in currency. Now these are real. I'm not talking about people trading Bitcoin. I'm talking about, people who are global, top of the line macroeconomic investors. And I've known a couple. And those guys are, the most famous macroeconomic investor that I know is George Soros. And I do recommend his book, The Alchemy of Finance, which is basically his diary for a year while he was switching, which you kind of see how his mind worked in terms of looking at the global economy. It's one of my kind of core texts for just understanding investment. I am not a macroeconomic investor, but we have to know, right? I think volatility is a very kind of simple way, without trying to get too funky with it, to know at least whether this is a moment to be looking at stocks or be careful, right? And again, when the vol is super high, we should be looking. And I think we'll see that in a moment now when we move to the stocks. All right. So since I've been talking so much, I think I'm not going to go first, even though I said I was going to go first. I think let's let someone else go first. Actually, you know what? I am going to go first because I want to show you all how I'd like you to do this. Next time I won't go first, but I do want to show you how I want you to do this because we can't spend too much. We have 3 stocks we're going to go through now. So I'll start with Apple, then we'll do Google, and then we'll do Tesla. And I'm just going to walk you through how I want us to look at what happened. We're going to compare the tools for the first and second quarter. So here we have the tool for the new quarter, fiscal third quarter, June 22. For Apple, actually, before we go there, let's just look at the stock. So right now, Apple stock is at 162. In the last month, it's up from 100. It was at 136, so it's had a huge upward move in the last month. Very positive. They did report the quarter last week, so the stock's been also further up since they reported the quarter. And year to date, the stock is now down 10%. So it has outperformed the market, even though it's down, right? The market's down 15, Apple's down 10. Now, the cash flow in the quarter for Apple was down year over year. So interesting that even though it was down year over year, the stock market responded favorably. I actually do not, I did not listen yet to the call, so I don't have a good view on why that is. I think we might, do something again to discuss if we have some change in view about the company. But let's just say, we'll look under the hood a bit. So cash flow is down. The implied value of the company is $135 versus $132 a year ago, which is up a little bit. And the reason it's up a little bit is because they bought back shares. So they bought back 500 million shares in the last year, which is a lot of shares. That's almost, that's about that's a 0.5% of their overall shares they bought back. So that means that even though the value of the company went down, the number of shares that it's being divided by went down. So the value per share went up. Now, this is why hopefully they bought back the stock when it was 138. If you're an investor and they think, oh my God, our business is way better than this, then and their stock has gotten tanked, we don't mind as shareholders that the company's buying back the shares. We like that, right? That's a good investment they're making. That makes sense?
Yes.
David, you got that?
Yes.
Cool. So just very briefly, I'm not going to spend too much time and I'm not going to do a forecast, but I'll publish the forecast for you all to play with later. You can see that iPhone growth, well, one other thing, let's go back to the top here. In the prior quarter, their cash flow was 26 billion for the quarter of March. Their cash flow from the quarter went down from 26 to 21. So now last year, the cash flow went from 24.5 to 21. So clearly it looks like there's seasonality, that second quarter is just a lighter quarter usually for them than the third. Third is a lighter quarter than the second fiscal third, just seasonally. And again, we can look at that. But so part of that is seasonality that went down sequentially, but it clearly went down more than it did last year. You can see that iPhone sales were slow. Basically, everything sucked at the product level, right? Now, services grew 12%. These numbers on subscribers are not updated, so ignore that for now. I got to get those out of the 10Q. But the overall service revenue was up 12%. And we know, by the way, what's important with Apple is they are growing their cloud services business, right? That's all of the subscription business. And you can see that business, they make 72 cents of profit for every dollar of sales on services. They only make 34 cents of profit for every dollar of sales of products. So services is their real gold mine going into the future. If you're an owner of Apple, you're really wanting to own them for the services business. Does that make sense?
Yes.
Services gross margin went up from 69.8 to 71.5. So also a very good sign, right? And makes sense because the cost of running the services business, which is primarily, cloud-based, big software, is all fixed costs. So the more revenues they have running through that, the higher their profits are going to go. So while I said I'm not going to do, if we just said they didn't grow any of the products, but they grew services by 12, call it 12% for the next 3 years. Why did that work? Oh, shoot, hold on. Oh, that's a mistake. Ah, jeez. Sorry, let me just fix something in here. Okay. Let's make this a little less, let's say 8. What would happen to the, and let's just say margins here continue to go up to, let's say they only spend 26 cents per sales. Then what would happen to the value of the stock? Well, that would take it up to 156, still below where it's trading. The other side of Apple, and then I'm going to let the next person go, is just level 2. The sum of the parts on the countries is now, oh, this looks somehow, there's a mistake. You know what, skip level 2 for the moment because it looks like there are mistakes in here. I was doing this quickly before we got started. So we'll stick to level 1, and that's the view. So why don't everyone stick to level 1 for the day, and we'll do level 2s later.
Okay.
And so, Ruslan, so I would say at this point that seasonally, Apple is, below its price, 17% in terms of baseline value. We do own it in the hedge fund. We'll discuss that at the end, whether and what we want to do with it. Okay, go ahead, Ruslan. Why don't you take over and do, I'll let you share screen. Hold on. You do Google.
Okay. So Alphabet recently reported earnings on the 26th. This is for their latest quarter, their fiscal second quarter. So just to briefly go over, the stock is currently trading at 116, and the operating cash flow for the fiscal second quarter a year ago was at 18 billion, and that increased to 18.7 billion from their latest report. So the implied value per share increased from $142 a year ago to $150 today. And then I'll be going over my level 1 forecast. But before I do, I can also briefly go over the older tool that we had from the previous quarter. So operating cash flow for fiscal first quarter of 2021 was at 15.5 billion, and that increased to 19.2 billion for the first quarter of 2022. So the value per share increased from 123 to 153. So I'm going to scroll down. So on my current level 1 tool.
Ruslan, before you
Yeah, sure.
let me ask you a question about that. So the cash flow value went from 153 in the prior quarter, the
Oh, yeah,
fiscal
let me-
first quarter, to down to 150 this quarter, right?
Yeah.
But relatively flat, right? So what that says on the one hand, which I think is important relative to Apple, because Apple went down a lot, and we said, well, some of that is seasonality, right? Because they just generally sell less in their fiscal, what is their fiscal third quarter. So one of the things we can say about Google is it's less seasonal than Apple, right? Apparently. So that this just is important to understand the character of a business, right? Because it makes sense, right? Because Google's not selling hardware. Google's really all software, right? I mean, what's Google's gross margin? Let's just take a look to compare to it, because we were just discussing Apple.
Oh, there we go. Okay. So in the latest quarter, it decreased 100 basis points from 57.6% to 56.6%.
So it's 56.6%. And we saw that Apple Services was 70 and Apple Products was 36. So they're kind of sitting in the middle of Apple, and but higher, more like a services software business than a product business, right? I mean, they're making over 50 cents of every dollar in profit, which is very high. Okay, keep going. Yep.
Okay. But it's also one thing that I also just noticed, but the operating cash flow overall, so it decreased from 19.2 billion to 18.7 billion
Right.
for this, from the first quarter to the second quarter.
Yep. And the growth was a lot slower, right? If you go to the top in the first quarter, it went from 15 to 20 to 19, and this quarter it basically it only grew up very little, right? It grew from
Right. Yeah.
18.
And from the earnings transcript, one thing which stood out to me, which consistently kept getting brought up by management, was the term they used was like lapping on like effects. So like they're facing tougher comps.
Right. They
So I
got a
think-
boost during COVID, and they're claiming they got a boost during COVID, right? And that means that this year they're lapping very high numbers from a year ago that were boosted by COVID, right?
Right.
Yeah.
So for the sales, I have it broken down by region. So United States, EMEA, so that's Europe, Asia Pacific, and then other Americas. So for the United States, so I went with 12% for United States sales, my forecast, 7% for EMEA, 4% for APAC, and then 14.5% for other Americas.
Okay.
Operating expenses and cost of goods, I didn't
Yeah, generally, we're not going to focus on forecasting those. We'll keep those percentages flat, only because
get those flat.
those are discretionary spending, right? The company can decide how much they'll spend on research, on sales and marketing, on G&A. They do not decide how much product they will sell. They do not decide how much it's going to cost them to make their products. So that's why we really focus our forecast on the things that they can't control, not the things they can. So let's go back to the top. Let's just see where you stand. So you're saying right now that you think it's worth 185 and trading at 116. So pretty strong buy on Google from the numbers that you have in there.
Right.
And the business seems pretty solid, though. Was there any discussion of why their expenses went up, why their margins went down?
For their margins, I think they pointed out for like certain segments, like YouTube, there was a reduction in advertising spend by some businesses. But otherwise, unfortunately, they didn't really get much more specific than that.
Okay, well, we'll put a pin on that and look in the SEC filing, because there should be some commentary legally. This is another good kind of just general investor point. Why don't you stop your share? Let this
Okay.
thank you, Ruslan. That the best source of research is the 10Q, because they can't choose whether to talk about things in the 10Q. When they get on a call, when they're asked a question, they can finesse an answer as long as they don't lie. But in the 10Q, they have legal disclosure rules that they have to follow. It's a legal document. So, Ruslan, if you look under gross operating spending, gross cost of goods sold, whatever, there should be some legit ways that we can, you call this forensic analysis, right? You're going in and basically looking through the filing to find numbers that will help you to do what we do. We're Sherlock Holmes, right? We're trying to use this limited disclosure to see deeper into the company than they'd like us to, getting inside their, getting inside their pants. All right, Armando, go for Tesla.
All right. Sorry. All right. We didn't get to talk about gas prices.
Oh, yeah, well, we'll do that maybe. Well, go to gas pricing for a minute because it's related, right? So gas pricing has been going up all year, right?
Right.
You can see just lately it came down a bit. So let me ask you something. Given the amount it's gone up this year and since the beginning of 2020, do you think that one downward move is enough to be convinced that we're out of the woods?
Absolutely not.
I'd agree. One of the things I think we have to recognize about market sentiment, does the market want to go up or go down?
The market wants to go up.
The market wants to go up. People want the market. Do the politicians want the market to go up or down?
They want us to go down.
What?
They want us to go down.
The politicians want the market to go down? Why would the
I
politicians?
can't really answer this question. I'm just assuming that they want us
Why? The politicians want everyone to be happy so that they get reelected.
Mm.
They want the market to go up. This is a problem with the Fed, right? The Fed is scared to raise rates because the Democrats want to stay in. The Democrats know if the economy goes into the tank, they're going to get blamed, and the Republicans are going to come back into the presidency and take over the Senate, and we're going to be living in a Republican country.
Mm.
The economy is the #1 factor in elections. So you have some gray thing up on your screen. I don't know what that is. Do you see that? Blocking your view? Yeah. Okay. So, all right. So I guess the other thing, just relative to Tesla, before we go to Tesla, is it good or bad for Tesla if the price of gas is going up?
It's very good.
It's good, right? I mean, we can acknowledge the demand for electric cars will go up as the price of gas goes up.
Right.
The relative benefit of owning an electric car.
Correct.
Go ahead. That's a big topic, which we can hit again at some other point on one of these shows. We'll do another show on Tesla. All right.
So as we may know, this is an old forecast tool from Q1.
Let's start with the new one.
Start with the new one. Okay.
Yeah.
All right.
Compared to the old.
So this is Q2 from last year versus this year. All right. We had a earnings report lately this month.
You have it labeled wrong in the latest quarter.
Okay.
I also don't think this is next to it. The latest quarter is not fiscal 1 March. This is fiscal 2.
Yeah. Apologize.
And you should. Okay.
Yeah, I'll update this.
No, don't worry, because this is not the tool that we have in the library. We should be using the tool in the library, not the one on your computer. Because but anyway, don't worry. Just keep going.
All right. So from last year, we had a operating cash flow of 1,402,000,000 compared to 2,154. Right. So we're doing better in cash flows. We see that the value per share currently from Q2 from last year is $94. However, it's been going down.
So why, if cash flow went down, did the value of the company? If cash flow went up, why did the value per share go down? That doesn't make sense. Go down to the bottom. That would only mean that the share, either their balance sheet changed. So net cash went up. So that'd be a positive. I think you have the wrong share count in there. Armando, this is not the one we worked on yesterday. Close this tool.
Right.
This is the wrong tool. Go open up, go to the website. Just go and make a copy of the one that we fixed yesterday that we posted. So that by the way, everyone, the new tool is available at the Forecaster Library. So, we should say this, and again, I got to remember this, is when we start the show, if you're watching right now, remember to open up the tools for the show so you can play along. You can make your own assessments while we're talking about it. You may disagree or agree. And eventually we will have the ability for you to, when we have 1,000 people watching the show, they'll be able to chat in with questions or comments or various thoughts on what we're talking about, because we'll have this in a more.
This is the one we worked on yesterday. I found it.
Okay, there you go.
All right. So I'll start over, right?
Start again.
So we had an operating cash flow of 1,538,000,000 on Q2 from last year. Compared to now, we have a Q2 cash flow of 2,299,000,000. So we have a value per share last year of 148. That's what Tesla's worth last year. However, Tesla apparently went up 2015, but as we know, Tesla's stock right now is currently at 891. So this is looking like a strong potential.
Wait. No. It doesn't look like anything except the market's selling it based on future growth. Right? I mean, we don't know what the future growth. We have to put in our own future growth to know whether it's long or short. Yeah. But right now, you're paying a significant premium. It's the cash flow value is basically 75% lower than where it's trading. So what does that tell us? It tells us that the market expects huge growth in the future, right? In other words, what does the market expect quarterly cash flow to be in 3 years? It says it right there. Under stock. Not there, next to it. What is the stock? This is important, everyone. Let me make sure everyone understands the logic. If the stock is trading at $891, right? No, what do you do? No.
No, I'm just putting it back accidentally.
No, don't change anything. Let me do, wait, Armando, let me just explain this to everyone because this is important, okay? The stock is at $891 million, right, David? Let's just make sure, David, you're gonna be my proxy to understand this.
Okay.
Got that, right? You got that?
Yeah.
There are a billion shares outstanding, correct? Billion 135 million. So the market cap of Tesla right now is $1,011,000,000, correct? You got that?
Yeah.
So that's what the stock is worth. So that means that the annual cash flow, according to the market in the future, is going to be that divided by 25, right? Because that's the multiplier. So in other words, the market is saying in 3 years, there'll be 40, because we view the stock price as a 3-year forecast. So the market is saying in 3 years, cash flow will be $40 billion a year. Because that's what the stock price is telling us, or 10 billion a quarter. Right now, the cash flow is 2 billion a quarter. So according to the stock price, cash flow will be roughly 4 times as high, 4 to 5 times as high in 3 years than it is now.
How much is because you're looking at it from this perspective to this?
Well, we're reverse engineering it. We're taking it from, instead of taking the operating cash flow and calculating the stock price, we're taking the stock price and calculating the operating cash flow. Does that make sense, David? It's the exact same math. Here we take the cash flow, we make it annualized by multiplying times 4. We then value the company by multiplying the annual cash flow times 25, right?
Yes.
And then we divide that by the number of shares, and that gives us the implied value. In this case, we take the stock market value, we multiply it by the shares to get the value of the overall company, we divide that by 25, and then divide it by 4 to get the quarterly cash flow according to the stock price. And we know that the stock price is a 3-year forward forecast. For every company, that's what the stock price is, right? That's the game right there. That's what you need to understand. So Armando, back to your earlier point, was right now, it looks super expensive, right? They have to grow their cash flow 5 times just to be a neutral, forget to be cheap, right?
Right.
Now, is that possible? Well, their cash flow went up in the last year by about, what would that be, about 40, 30, 35, 40%? Well, 35, 40% per year. Let's just try that. Let's just say, I mean, that would not get you, I don't think, to 5 times. That would probably get you to 3 times, 2 to 3 times.
Mm-hmm.
But in any case, we won't, let's say what, since Tesla's an important name, let's just play real quick. Let's just put in a forecast down below. Oh, wait, one other thing. Armando, go to the last quarter tool. What was the company worth the last quarter?
It was worth 891.
No. Stock price is the stock price. What was it worth last quarter?
96.
No, that's a year ago.
335, sorry.
The baseline value from last quarter was 335. So what happened sequentially? It went from 335 to what?
148.
No, that's a year ago. 215, right? That's this last quarter, 215. 335 to 215.
Oh, it went down. Yeah, it went down.
So the cash flow value of Tesla went down sequentially.
Hmm.
Now, is cars a seasonal business?
No.
Not necessarily. I don't know. I mean, we'd have to look into it. But in general, people are buying cars all year, I would assume. So the fact that it went down sequentially, does anyone, well, I think if we go to level 2, go to level 2. Go down. I think, what happened in China? They sold 65,000 cars in China, right?
Mm-hmm.
How many did they sell last year in China? Go to the other tool. Go to the other tool. Last year in China. I'm sorry, last quarter in China.
They sold 81,000.
So their sales in China went down by 20,000 cars sequentially. We know that they've been having problems in China because of COVID, right?
Right, Shanghai. Yes.
Right, and then this is something that's been a lot in the press. Okay, so go back to the new tool.
Yes,
Okay, you're there. Go to level 1. Let's just say for a moment, go down. Let's just say that they continue to grow the number of cars by 25%. Okay, that would mean they're selling 496,000 cars a quarter in 3 years, right?
Hmm.
And let's say the price per car goes up. They had to raise their pricing by 13%. Let's say they continue to raise by 10% because of inflation and cost and everything. That means the average cost per car will be $76,000 per car. That's expensive. I don't know if that's going to work for them. And then let's go down to the average cost per car. Let's go down there. What happened to their cost to make a car in the quarter? Cost. What happened to the cost per car?
It went up
By how much?
by about 14%.
Yeah, not about, it went up 14%, right? So let's say it continues to go up 10% per year.
So that brings it up to 55,000 to make a call.
Okay, so what's our price target then? Let's just call this a very quick back of the envelope forecast.
506.
So if they were to grow their sales at 53% a year, and still have costs going up, then this is not a buy, right? Okay, why don't you stop sharing, Armando? Let's cut this off here and let's end. It's 9:07, we're a little over, so let's just wrap here and take a look at the fund. Let me open the hedge fund here for a second. Okay. Okay, so here's the IVoT hedge fund. We currently have, it's an 110 million IVoT fund. We only have 10 million IVoTs invested. So we have way too much cash. We need to invest more of our fund. And so that's what we'll be working on, right? Our target as the hedge fund would be to actually be 200% invested, meaning what I'd like us to have eventually is 100% of our IVoTs in longs and 100% of our IVoTs in shorts. So we're market neutral and we have a full set of positions on each side of the book, long and short. Generally, for a fund of this size, that would mean 20 longs and 40 shorts. So we're just getting started in building this out. It's like a new fund. But like any new fund, if I opened up a fund tomorrow, would I invest it all in one day? No, that would be completely outlandish. It would take us some time to build up our investment. So that we're actually going about this in a relatively correct way. Now, what are the positions we own at this point? We own Apple with a price target of 235. Well, I don't think we didn't really go through the price target, but it seems like that might be high. And the stock market, the stock's been going up. So we may want to take a look at that position. That's actually our biggest weighted position. We've made money in it, right? Because we spent 2.2 million IVoTs on our position, and it's now worth 2.4 because it's been going up since we bought it. Right? Because we bought 1% position in our fund is 1.1 million IVoTs. Does that make sense, everyone? We're 110 million IVoTs, so every 1% position we own is 1.1 million IVoTs. We have Google. Google's actually gone down since we bought it, even though it looked like the cash flow in the quarter was better. Let's actually look at that chart real quick. I have that chart open. Year to date, Google's down 20%. It's worse than the market. Interesting. Underperformed the market. And it did come back this week, but it has not come back nearly as much as Apple has, right? So we're not far from making money in it, but we've lost. We spent 2.2 and we're at 1.168. Meta, we spent 1.1. We've actually made a little bit of money in Meta because we only own a 1% position there. Meta has our biggest return. Well, no, Meta and Google both. Is your price target, Ruslan, still 235?
No.
Okay, let's update that in the trade sheet. What's your price target now?
This for like level 1 that we did today.
Yeah, I mean, you can update it, but your latest price target based on the quarter is what?
Oh, I did level 1, level 2. Oh, no.
Well, you tell me, and then you'll just have to defend it. Again, you guys will get paid in IVoTs based on your return, 20% of your return. So I'm trusting you. I'll obviously ask you questions, but what's your price target?
Both 185.
185, let's come down a bunch. Okay, so let's go back to the tools. So based on our overall score of 9.4, Google's implied right now at 16%. We only own 2%. The most we'll buy is 5. So we're still okay at that return because it's still an interesting name, but it's not above 2. Above 2 is a great score. Between 1 and 2 is good enough. Anything below 1, we really shouldn't know. Now, let's go to, I'm going to actually lower my price target for Apple a bit, just based on what we covered here. Just for the moment, I'm going to take that down to 200. So I don't think we're buying it. And that score is actually below 1. So I'm not going to buy any more Apple for now. I'm not going to sell it yet, but it's on the watch list for a sale. What is that?
Where did I buy Tesla? And I'm gonna change my price target. But I'm looking.
So that's right. Then we're doing that next. So Armando, where do you want your price target to be?
I want to protect my gains, so I'll just keep it like 900.
Well, wait, you got to right now. Well, you can't make that number up.
No, I'm saying that I'll take it out now. You know.
No. Don't worry about that. I'm the portfolio manager. You're not. You're the analyst on it. I'll decide what to do with the stock.
Okay.
But at the moment, your price target based on what we just went through was below.
It was like 500. It was 516.
Is that the one you want to use?
Yeah.
Okay, so then we go here and we say 516. Wow, that's a negative 42%. Now it looks like a short, right?
Mhm.
So I think what you should do is
Okay,
do
what's my price? I know I bought it, but I don't know where I bought it at.
well, we made money in it because we bought it, you know, definitely way below 891, right? We can look here. We bought it for we bought it for 734. It's been a good return.
Yeah, so just protect my game.
So you want to sell it.
Potentially, yeah.
You're absolutely all supposed to come to me with recommendations, whether I agree or not. So here's what I'd like you to
But
do.
I would just keep it.
Armando, before you do that, have you read the transcript?
Yes. That's
So-
what I'm saying. I just want to like just send you like a research report paper, and then that'll tell you why I'm going to short it.
Perfect. So send me a comment on why you want
I'm
to
gonna
change
tell
the
you.
position, and then we'll get that done this week.
All right. But
Um,
short it yet.
cool. I mean, you know what? Honestly, if you want to sell it, our price target's so far below. Let's just do it now. Let's just sell it. So let's just do it. So Tesla, that's the point of the show, is to play. We want to be nimble. This is all right now. All these positions are basically, none of them are core yet because we're still learning. You all are learning, and so our new price target now is 5. Oh no, the stock price right now is what is it? 891 or something.
Yeah, 891.
Yeah, so 891. Today is July 30th.
Mhm.
Our price target now is 516. Our new target. The volatility is probably,
Negative 42.
what's the volatility now?
It's a negative 42.
No, implied vol.
I can check. It's a 60%.
60. Okay.
Hmm.
And we're going to do a negative 1% order. Well, actually, no, it's actually we're going to get rid of it. So we're going to sell our shares. Collect our cash.
I have a question.
Yep.
Can you sell a little bit less than 1%, and then when I have my research paper, put in the rest of the percentage so I can have a higher price in my sell target, my sell price? Or how does this work?
Wait, say one more time. What?
So you see how price 891, but let's
Yeah.
say that I wanted to send the research paper first, and then let's say the price goes up like to 950. Is there possible like to dip in a little bit now and then just add more later on, like less than 1%, and then the rest of the 1% to not risk the hedge fund portfolio?
Wait, you don't want to sell the whole thing?
No, I want to sell my profits because my next move is looking to short it.
Yeah, so no, so
I just wanna-
I didn't understand. One more time your question. I'm sorry, I couldn't finish it. Go ahead.
So is there a way, because I see you want to short it today?
No, I'm not shorting it. No, I'm just selling what we have.
Oh, okay, cool.
No, we're not ready to short it. I'm not ready to
All
short
right,
it.
all right.
Tesla's a little scary to short. It's a very
That's why okay, thank
no,
you.
but all I'm doing is saying. So I want to cut. I need to do this. This is all helping me with the.
Yeah,
So we
because I
started out,
misunderstood you. I thought you said you want to sell it
we
today. I'm
started out with.
like-
Let me make sure. Put this in the right- Yeah, we started out with 110 million IVoTs. And now we've got a total here spent and ads and then total. So at this point now we've spent this number, right? This is the total we got in, but then we added back. We have to add back what we sold. So this will be negative this, right? So our total fund. Oh, this should be a negative. Sorry, negative what we spent. Oh no, shit. Oh yeah, that's right. Ads and then total. So we got the 8 million in stocks. Plus the 110 million we started with, minus what we spent on stocks. Oh no, shit. I just want to calculate our IVoTs, right? So this should be equal, our total IVoTs is equal to what we spent, what we started out with, less minus or plus, or less what we spent. Less, so right, so it's 102 million IVoTs left. So that should be, and this would go to our ads, right? Because we just added from the cash. I'm going to change the way this is laid out a little bit, but you guys understand what's going on here?
Mhm.
Yeah, then it calcs right. So we have 113 million IVoTs, which means we've made 1% on our portfolio at this point, 1.8%, which is actually not bad considering we're only 9% invested. It's actually pretty good. You know how we could think about that is if we multiplied that, if we were 100% invested, that would have meant we would have made 10%, over 10% on our fund in since we started. In other words, we're actually doing pretty, that would be a super strong start to the fund. Oh, but no, sorry, something's wrong here, sorry. No, I'm overstating it, shit. Hold on. Because this should equal to, nope, sorry, no. News is not as good.
Oh.
I was like, that looked too good to be true. I was excited, but no, let's get on. I gotta take out the shares that we just sold. Okay. Now we're up 0.6%, which is still though, again, 6%, that would be 6% a month. I have to say that's still a solid return, believe it or not, considering how little we have invested. Because again, let's just say we've been playing this game for a month. Again, I'm just trying to give our kind of performance a reasonable view, right? If we think that we've been playing this game with the hedge fund for about a month since we started, and if we made, on a fully invested basis, 6% in the month, 10 times 0.6%, 6% in 1 month is a huge month, right? I mean, that would be a 60 plus % per year return rate. However, let me tell you something else, and this is something we'll have, and this is gonna be my last comment for the show, and then if anyone's got questions, I'll open it, but I think we've been going pretty long. But let me just say this. If our fund goes up at the rate of 6% per month, that could be viewed negatively. Why? How would someone interpret that in a negative way?
Repeat your question, sorry. Okay.
So let's just say we're saying that on a kind of adjusted basis, we were up 6% in the month.
Mhm.
And my question to any of you is, that's a big positive return. Why? How could someone come to us and say, "Oh my God, that's scary"? That makes me nervous.
I think probably because you would have to take additional risk in order to achieve those returns.
It implies a lot of volatility. I mean, Tesla goes up 20% a month. Does that make it good? No, because it goes 20 down 20% the next month. When we run our portfolio with a long short book, that won't happen. We won't have 6% months. Hopefully, we'll have 2 to 3% months, very steady. And that will show that we're running a very controlled volatility. Our boat is very safe, and we're teaching people how to make money long-term on a very safe basis, not riding a bucking bronco. Does that make sense?
Yes.
So when you look at an investor says, "Oh my God, we're up 50% this year," you're like, that means you could have been down 50% this year. That's your vol, right? What goes up can also go down, right? The fallacy of, again, I'll recommend another book again. I recommended before, Fooled by Randomness by Nassim Taleb, very famous writer about risk in investing. Fooled by Randomness is his first book. I think it's the easiest one to read. He's got other more famous books. The Black Swan is his most famous book. But understanding that what looks good on the surface can hold a lot of potential risk in it. I mean, how many people put money in Bitcoin because it kept going up, and they lost 50% of their value this year? So we're here to learn what I would call disciplined, strong investing skills that we can apply to our own money, and that we can ultimately, if you want, as professionals, apply it to other people's money in helping them run their money, including on the IVoT platform, because you're all running your IVoT. So definitely get your IVoTs invested. You're supposed to, our target for each of you is to get, at least, ultimately 200% invested. I want to teach you how to run a hedge fund, really run correctly, because there are typically going to be, in the real world, you can find overvalued and undervalued stocks. And I think, to Armando's point, Tesla's a scary short. Doesn't mean it's not a good short. If we really think that they're facing troubles, then I think it could be interesting, right? I mean, one thing I can say about Tesla is they've had the electric car market to themselves so far, pretty much. And I don't think that that's going to be true going forward, right? I mean, basically all the big car companies are preparing to launch a lot of competition to Tesla. That's why Armando's market model is going to be so important to us. We really have to start evaluating what companies are launching cars over the next 3 years and how that's going to affect the overall electric car market. And that will give us an idea of what to expect from Tesla. That's called analysis. That's not called, that's not, here's what I think. That's what we want to get away from, right? We want to get to the numbers, get to the model, be solid with our view. If Volkswagen and Ford and, all the big car, Toyota and Nissan are all launching electric vehicles as core parts of their portfolio of cars in the next 3 years, well, Tesla's not going to have it to themselves. And all, power to Elon for what he accomplished, but what does that mean for his business? I mean, yeah, well, it's. If
it comes to a steady price, I don't think Tesla's gonna be worth 1,200 on a regular basis in the future. Me personally, and that's just based on the transcript and the forecast tool and their investors relations, financial reports. I mean, all of this just comes to.
Yeah, I think and then I will end here, but I think the one thing I want to say that's important for each of us is we're looking at money systems. What they sell is a mask. So to your point, Armando, there's so much hype around Tesla and Elon and stuff that's a mask, but there's a system behind that is simply meant to generate profit. And that's what you buy. You're simply buying a machine, a money machine meant to generate profit. And now Tesla's built a great brand, no doubt. It's a brand that's very respected around the world. But, Mercedes has a great brand, and Mercedes hasn't really come after Tesla. Toyota has a great brand. They have not come after Tesla yet. They haven't come after Tesla because it takes these companies a long time to move their business. They're big beasts. They're trying to turn the Titanic. But, they have to do it. They've all realized at this point that they have to get into the electric car market for serious. Because, right now, Elon's Tesla is worth more than all the other car companies in the world combined. That's a real context for what we're talking about, right? More than, if you add up Mercedes and Porsche and Toyota and Nissan and Honda and the Korean car, all of them combined are not worth as much as Tesla. That seems like it could be bubblicious. Now, a lot of people have gotten burned being short Tesla in the last 5 years because they were way too early. And honestly, like 5 years ago, you were buying stock for 50 and there were people short the stock. And I looked at that and I said, no way, that's nuts. This is worth at least a couple $100. And even now, we're not saying it's not worth $500 or $600, but it's not worth 900, let alone something that we could own for a return, right? That's called disciplined investing. That's called being a real investor. All right, I think this is a good show. I'm going to end it now, and thanks all for participating. Why don't you just stay on for a couple of minutes? We'll discuss the show, or, kind of critique it, and then anyway, for everyone else here, see you next week. If you've been watching this, we will, I believe, be looking at Uber next week. And I would recommend, as part of that, if you get a chance, there's a documentary on Showtime about the creation of Uber that Gala and I have been watching, which is, it's I would give it a kind of a B in terms of the overall quality of it, but it's still a great story and interesting, and about entrepreneurship and the whole world of Silicon Valley and building a unicorn, as they call it. A unicorn is a startup that kind of creates its own space as a global space. Facebook was a unicorn, Uber is a unicorn, Google is a unicorn. They kind of, their name becomes synonymous with the whole product area. All right, thank you, everyone. I'm gonna stop the recording.